Hi, this is Bonnie Kelly with Hilton Worldwide, and I'm here today with Doug Friske with some new research on how high-performing companies pay executives. Hi, Doug.
Hello, Bonnie.
Hi. Tell me a little bit about the study.
It's an outgrowth of work we initiated a couple of years ago regarding guiding principles for executive compensation. As we're looking to outline for our clients how they should think about their executive pay plans, we thought it would be helpful to see if there was information out there regarding how high-performing companies structure their executive pay, see if they do anything different. And so what we did is we looked at 15 years worth of data, total shareholder return data, to identify those companies that consistently over those 15 years beat the S&P 1500 average. So we found, identified 50 companies that met the criteria we laid out. And so using our proprietary database that go back over that period of time, we looked at the pay levels and the pay structure, so both the how much and the how questions, to see if we could learn anything from how these really high-performing companies do things different.
And what did you find?
It was interesting. As you might expect, you're thinking about companies across a spectrum of industries. These companies represented 16 different industries, ranging anywhere from 500 million in revenues to 150 billion in revenues. You would expect there'd be a fair amount of commonality in their practices, and there was. For example, how they set their compensation targets were consistent with broader industry. We didn't really see target opportunities that were different from the enduring high-performing companies versus the marketplace. Their pay mix was pretty consistent with how other organizations structure their pay. But a few things were different. One was they tended to have a much longer-term orientation to their practices. Two is life cycle mattered. What we found is that as companies migrated through from a more smaller size basis to a larger basis in their revenues, their practices changed. And in fact, when they're in their early stages, much more differentiated in terms of how they're structured their pay package. We also found that choice on long-term incentives really mattered with respect to realizable pay, meaning how they chose to structure their long-term incentives had a big impact on the pay that was realized by the executives. So some pretty meaningful differences.
When you talk about long-term focus, can you talk a little bit more? Was it the design of the plans in particular? Give us a little more detail on that.
Sure. A couple things. One is largely on the design, but one example. You look at vesting schedules for these organizations. The enduring high-performing companies were much more likely to have longer vesting schedules than the broader marketplace. So for example, on stock options, 70% of these companies have vesting conditions that extend beyond 3 years, whereas in the broader marketplace, it's roughly 40%. Unrestricted stock, the enduring high-performing companies, 2/3 use cliff vesting, whereas roughly or less than 40% use cliff vesting. So a little bit longer term there. With respect to the design of their long-term incentives, they're much more prone to use stock options. In fact, of these companies, 27% of the enduring high-performing companies only use stock options. That's their only long-term incentive vehicle.
Even today?
Even today.
Interesting.
Versus 3% of the broader marketplace. Right. So you might say, okay, that's on the choice of vehicle, but what about how they deliver value? Well, with respect to the actual delivery of long-term incentives, high-performing companies have almost half of the value delivered in stock options, so more than roughly 41%. Whereas for the broader marketplace, as we've all experienced, we've seen the trend towards performance plans. So for the broader marketplace, almost half the value is in performance plans. So a pretty stark difference in their practices on the long-term incentive front, which, as I said, has an impact on the actual value realized over time.
Were you able to glean any information on how these companies have been perceived in the marketplace and by institutions? Because I think there's a lot of pressure in the market to go toward less options. ISS and other organizations don't look favorably on that. You know, how have these companies been perceived in the marketplace from institutional holders and so forth? Really taking a different approach, but then sustaining performance over the longer period.
Right. We didn't do any in-depth research on it, but just from looking through the companies and their history, the fact that they perform so well clearly has had an impact on how they're perceived. And so given that they have been high-performing organizations on a total shareholder return basis for an extended period of time, I think allows them some flexibility in terms of their programs and how they might be viewed by proxy advisors or other interested parties.
So what should companies take away from this research?
I think there's probably three things as we've looked at it. One would be that life cycle matters. Where a company is in its life cycle should have important considerations for companies in how they design their plans. I think for many organizations, like proxy advisors, when they look to assess programs, they try to fit a single lens onto those programs. And what we really learned was that it needs to be different. As a company is going through a more growth phase versus a maybe midlife, and then finally the mature phase, how they structure their plans really does matter and has a relationship to their strategies. So that needs to be considered, be one. Two is that taking a longer term orientation also has some value. So not trying to track the latest fads or what else is going on in the marketplace, but looking at programs long term and being willing to differentiate from other programs, other companies that are out there. The third thing I would say is that compensation programs have to be viewed from the standpoint of their ability to strategically differentiate a company in the marketplace for talent. Companies need to take the offensive in terms of how they view these programs and not take the defensive standpoint in terms of why they do what they do and how they structure their programs. And I think by doing so they can ensure, I believe, long-term sustainable high performance.
Yeah, it's really interesting research because I think that's, to your point, not what we're seeing in the marketplace in terms of common longer-term pay design. So fascinating. And how can our World at Work practitioners learn more about this study and they can consider some of these data points as they think about their future designs?
I think if you go to towerswatson.com and look for high-performing companies, you'll be able to find the link.
Well, great. Thank you, Doug.
You're welcome, Bonnie. Thank you.